Hello there guys, thanks for tuning in. This is David from Critical Trading, and in today's video I'm going to cover one important and easiest way of diversification in your systematic trading. Before we get to that video, make sure to check my brand new free webinar if you haven't done so already. I'll put a link down in the description of this video. In that webinar I basically show you how to get started in systematic or algorithmic trading, and alongside that I will present a fully systematic trading strategy that made over 100% return in 2020 alone, alongside with its full rules. So make sure to check that webinar out, link in the description. Now, when it comes to diversification in trading, most people would think about owning different asset classes in their longer term portfolios. So for example, people would own ETFs that track the stock market, like for example the SPY, in combination with some ETFs that track the real estate market and some materials, for example. So this would be the most basic form of diversification that most people think of when they hear the word diversification. Now, more advanced or more intermediate traders, especially in the systematic trading world, would try to diversify by having two different strategies. So for example, the two equity curves that we're looking at on this screen show two of my strategies that I trade in my own portfolio. The turquoise line here is a low exposure, higher trade frequency, mean reversion type of system that I trade on all US stocks that are traded on all US exchanges, whereas the green equity curve belongs to the system that only trades on a weekly basis. So it uses a weekly time frame. It trades all stocks in S&P 500. And its nature is a little bit different, obviously, to the mean reversion system. So these two systems diversify each other quite well. And this is the kind of a most common type of diversification that most people in the algorithmic trading arena think of. That's not what I want to show you today. There is one form of diversification that is simpler than this, yet most people don't know about it, and actually it achieves the same effect as diversifying by trading two different systems. Essentially, what you want to do when trading different algorithmic systems together in a portfolio is that you want to give yourself high chances or high odds of having at least one of the systems, being profitable or having profitable period if the other one is losing. So you are achieving diversification, and that results in a smoother equity curve. However, like I said, you don't actually need to trade two different systems or multiple different systems, because there is a simpler way to do so. Now, before we have a look at that, let's just stick with these two different systems. Like I said, one of them is a mean reversion type of system, whereas the other one is more of a trend following type of system. I present both systems in my flagship online course called 5-Week Portfolio. It's my main premium training program that comes with 6 different strategies with their full codes as well as the crash course in Ami Broker, which is the software that I'm showing you on the screen here as well. And I also provide a hands-on support in my private community. If you don't know how to start in systematic trading and looking to get started very, very quickly, have a look at my 5-Week Portfolio program, link in the description. So if we look at these two systems, we can see that their overall correlation across the entire data set that I tested them on is quite low. So overall, these systems are not correlated, which is exactly what you want, like I just described. Let's have a look at the mean reversion trading system in more detail. So this is an actual trade that this system just made a few days ago before making this video. If I just zoom in a little bit, we can see that this system bought this stock in the area of green circle, specifically on that horizontal turquoise line that's visible on my chart, and then it closed the trade where the red arrow is. If I just check my brokerage statement as well, this is the actual trade. It's ticker TMST, and I entered at price of 17.17. And basically what this system does is that it waits to establish that the given stock is in an uptrend. It waits to establish a certain momentum in the market, and then after that has been established, it waits to see the stock making a pullback after that. So it essentially is trying to buy stocks within an existing uptrend, but at a pullback. So this is not a momentum system, this is a mean reversion system, and it buys the stocks using limit orders. These limit orders are prepared by my scripts in advance in the morning and are transmitted to my trading platform as well. And it then closes its positions at the first up day following the entry. So typically this system holds its positions for an average of 3 days or so. And now let's get to the main part, and that is what to do in order to diversify the system without having to diversify it with a different system of a different nature. And this is the simplest form of diversification that I personally use as well. And that is, instead of trying to find a different system, because that's quite difficult, believe it or not, you know, finding a working trading strategy is not that easy. And so it may be a good idea to just take the existing system, so this mean reversion system in this case, and just playing around with its entry and exit rules to make it a little bit different, in the sense that it suddenly becomes almost an intraday system. And that is the form of diversification I'm talking about in this video. So it's not diversifying using different systems altogether. It's diversifying by taking one system that you already have and changing its entry and exit rules slightly to make it a little bit different. So for example, this system is a swing trading system. That means it holds its positions for, like I said, about 3 days. But what if I have played around with the finer details of it? So for example, instead of buying at the horizontal turquoise line on my chart, I would buy a little bit higher. So I would use a different limit placement framework, and I would be closing the trades at close instead of holding them overnight. So I would essentially take the system and kind of rework it into something in between swing and intraday system instead. So suddenly I have two systems which are based on the same system, obviously, but are quite different in their nature. One is swing trading system and second one is intraday trading system. So what if we just did this instead of, you know, having two completely different systems? Like I said, it's quite difficult to get these strategies that actually work long term. What would be the effect on our portfolio if we trade both of these together? How would it look like in terms of, you know, diversification? Would we get any? Let's have a look. So what I'm showing on the screen now are the results of 3 different backtests. So the very bottom result is the original mean reversion system. This is the swing version of this system. Then the results in the middle are of the version of the system that was redone into an intraday type of system, as I've just described on the chart, okay? And we can see that the number of trades is obviously higher, which makes perfect sense. Then what I've done, I have taken both of them and traded them in a portfolio, giving 60% of the capital to the swing version and 40% of the capital to the intraday version, and trading them both simultaneously. And we can see that what happened is that the average annual return, or the rate of return, went up from 28% to 31% when compared to the original swing system, whereas at the same time my maximum drawdown went down from roughly 10.5% to 7.3%. And also the Sharpe ratio of this combination is the highest across all tests, which is exactly what you want to achieve. Sharpe ratio essentially translates into the smoothness of the equity curve. And let's have a look at the correlation matrix as well. We can see that these systems actually show a slightly negative correlation. I hope that you found this video helpful. Like I said, I think it's a great idea to just take your existing systems and try to make different versions of them and then play around with trading them in a combined portfolio to see what their correlations are. Thank you very much for watching. David at Critical Trading, signing out.